Every day, millions of Americans wake up, go to work, pay their bills, and slowly fall behind. Not because they are lazy, not because they lack ambition, but because nobody ever taught them how money truly works. Tonight, Spotlight Business Report begins a new mission, teaching ordinary people how to begin building wealth, data-driven, fearless, fueled. For generations, people believed saving money in a bank account was enough. But inflation quietly changes everything. Every year, the purchasing power of your cash slowly declines. That means the same $100 buys less. Over time, investing changes the equation. Instead of simply working for money, your money begins working for you. And the greatest force in long-term investing is compound growth. This formula may look intimidating, but the concept is simple. Over time, investment growth begins generating additional growth. This creates a snowball effect. Small investments made consistently over many years can eventually become life-changing wealth. The goal is not to become rich overnight. The goal is to begin. In the next lesson, we will explore M1 Finance. The stock market once belonged almost exclusively to Wall Street professionals. Today, technology has changed everything. Platforms like M1 Finance allow ordinary people to begin investing with remarkable simplicity. M1 Finance is focused on long-term investing. It emphasizes automation, diversification, and discipline. Its most important feature is something called pie investing. Imagine your investment portfolio as a pie. 50% may go into a broad market ETF, 25% into growth, 15% into dividends, and 10% into individual companies. One of the most powerful beginner features is fractional share investing. In the past, investors needed enough money to buy full shares. Today, even $10 can begin building a portfolio. M1 Finance simplifies the process, but simplicity does not remove responsibility. In the next lesson, we will open a real beginner investment account step by step. Starting your first investment account may seem intimidating, but modern platforms have dramatically simplified the process. First, create your account using your legal identity and banking information. Brokerages are heavily regulated. Identity verification is required. Next, choose your account type. Most beginners start with taxable or Roth IRA. A taxable account offers flexibility. A Roth IRA offers potential tax-free retirement growth under current tax law. Many investors use both. After connecting your bank account, you can begin funding your portfolio. The key is consistency. Long-term investing is not about timing perfection. It is about disciplined repetition. Now let's explore what you are buying. One of the biggest beginner mistakes is believing you must pick the next superstar stock. Many start somewhere simpler. Think of an ETF as a basket containing many different companies. Instead of buying one stock, you buy exposure to many. One of the most popular ETFs is VOO, which tracks 500 major American companies. Another is QQQ. QQQ contains technology-focused companies, and SCHD is often explored by dividend-focused investors. ETFs reduce concentration risk. If one company struggles, the entire portfolio is not destroyed. This is why many beginners start here. Now that we understand ETFs, we are finally ready to build a complete beginner portfolio. A portfolio is not simply a collection of stocks. It is a financial blueprint. Every allocation tells a story about risk and goals. This example is for educational purposes only, but it demonstrates how a beginner portfolio might be structured. 50% broad market ETF. 25% growth, 15% dividend, 10% individual companies like Apple, Microsoft, or Nvidia. The goal is balance, not excitement. A portfolio should survive difficult markets, not simply perform during easy ones. Now it is time to automate the system. In the next lesson, we explore M1 Pie investing. Automation is one of the most powerful advantages available to modern investors. Portfolio building in M1 is built on pies. Each slice receives a target percentage. The platform then automatically allocates deposits according to those targets. Over time, certain investments grow faster than others, changing the balance. Rebalancing restores your target allocations. Investors can also automate recurring deposits. This creates investing discipline even during emotional markets. Automation removes one of the greatest enemies in investing, human emotion. Next, dollar cost averaging. Many beginners believe successful investing requires predicting the perfect time to buy. History suggests otherwise. $100 monthly, $250, $500. The exact amount matters less than consistency. Successful investing is remarkably boring. $100 monthly, $250, $500. The exact amount matters less than consistency. Successful investing is remarkably boring, and that may be its greatest strength. In the next module, beginner mistakes to avoid. Most investment losses do not come from lack of intelligence. They come from emotion, panic selling, chasing hype, overusing margin, buying investments without understanding them, attempting to get rich quickly. The market rewards discipline over excitement. In the next lesson, we explore the psychology required to survive long-term investing. The market is also an emotional machine. Legendary investor Warren Buffett once said the market transfers money from the impatient to the patient. Markets rise and fall. Volatility is normal. Fear is normal. The challenge is remaining disciplined. Long-term investing rewards patience. Most people overestimate 1 year and underestimate 10. Create automatic contributions. Review quarterly. Avoid emotion. Continue learning. Building wealth begins with education, then discipline, then time. Your portfolio may begin small, but every journey begins somewhere. This has been Spotlight Business Report, data-driven, fearless, fueled